South Africans that are living abroad, that's your clients possibly, or maybe yourself, are facing a wave of fast-moving tax changes, and the rules just keeps on shifting. I don't know if you realize that or noticed that. I definitely did. But whether you're advising clients with offshore assets, or you're helping them immigrate, or simply trying to keep up, this is an episode that you simply can't afford to miss. And I've got the absolute master in my mind, Hugo van Zyl, join us this morning to help us unpack what is new, what's urgent, and what to expect next. So fantastic. Looking forward to a good one.
Welcome to PROpulsion, the weekly show for financial planners and advisors who want to build better, more successful businesses. I'm your host, Francois du Toit, and every week we dive into the practical strategies that matter, from growing your client base and improving your services to developing yourself and your team. Whether you're running your own practice or you're part of a larger firm, you are guaranteed to find actionable insights to help your business thrive. So with that, welcome, and let's get into today's episode.
Let me introduce you to Hugo van Zyl before I bring him on screen. So as you now know by now, my guest, and he's not a stranger to many of you, I'm pretty convinced of that, but my guest is Hugo van Zyl. He is a well-known trainer, lecturer, and cross-border tax expert. He's been trusted by SARS to lecture on capital gains tax when all that stuff came out. I'm obviously throughout, and worldwide taxation, and has presented regularly for over a decade. You might know him online as Wegganer. There's quite an interesting story behind that. We support South Africans living abroad and planning to move overseas. Hugo is based in Cape Town. I run into him sometimes. Well, both times I ran into you here, Hugo, like it was completely unexpected. So that's amazing. But he also holds UAE residency with a practice focused on expats, and he works with clients around the world, including financial institutions, advisors and regulators, and with deep experience in immigration and tax, and a strong presence in the professional space. Hugo brings a wealth of knowledge to the table, and especially when it comes to navigating double tax agreements. So Hugo, welcome back.
Thank you.
After all of that, that's what you got to say. Thank you.
I'm like devastated. Can you imagine putting this old man after such a pretty lady? So yeah,
no, I'm sorry.
You're making it tough, eh? And after such a vibrant person, now I must come with all the boring stuff. But I think more important to say welcome and hello to everybody. I saw and recognized lots of the names. And if I can quickly go and just say, do you think Kobus Klein is still in Turkey? You know, we can never keep up with him. There's one guy who beats me. I have FOMO when I look at his traveling. He's really showing us how South Africans can be digital nomads working all over. So my client base includes those digital nomads, and that's some of the topics I'm going to touch today.
Yeah, I'm excited to get into it. If there's two people who can bring tax alive, it's you and me, but it's basically you, because I'll just ask the questions and then you'll do the rest. So I think let's just get into it, because there's a lot happening, and I don't know how much gets publicized, but maybe just because I'm looking too much at all the AI stuff at the moment, I'm not seeing all the other things, but there's a lot happening, and I'm quite keen. I mean, there's been a lot of changes around the exchange control regulations and that in relation to South Africa, South African expats. So can you give us an update on that and what's been the most recent changes?
Shall I start with the not update? Okay. So for those of you who know, you can go to the Reserve Bank's page called ResBank, resbank.coza. Then you go to what they do, financial surveillance, and there you'll get all the circulars and the recent updates. So with Budget 301, it's quite interesting that the Reserve Bank updates have changed and some has disappeared off the webpage. So for example, there's number 6, appointing Old Mutual as a bank or restricted bank. Now, for those who don't know, a restricted bank can only do credit cards. You can't go and buy currency at their branches, okay? So they were added, and we all know they're busy with a big getting back into the market as a bank. But quite interesting is we have Circular 1 and 2 that was announced on the 26th of February as policy. And now if you go back, there's a red cross line draft for comment. because the budget was reversed. Now, remember, that announcement was part of the budget policy. So the big change that affects people like myself and Cobus Klein, if I can use him an example. Now, I'm only out for 3 months at a time at the moment. I'm no longer doing that 9 months at a time. But I think Cobus is still doing extremely long periods. So for him, not so important, but for me, very important. If I bought my rands, my dollars, way back in January, I paid just over 18 Rand. When I recently had to start traveling, the Rand was touching 19 Rand to the dollar. So in the old days, when I came back, I had to put my dollars back into South African Rands unless I would be traveling within 90 days. So someone asked me the other day, why were you in Dubai in March, got back, and now you're back in May? The reason is, in the current rules, I have 90 days to use that dollars, also reuse them, or I must give them back and buy rands. Budget date, they announced that we no longer need to give that rands back in South Africa. You can, at the end of the year, or when you come back from your traveling, you could deposit that dollars into a foreign currency account in South Africa. Okay, so all the banks on their bank platforms have. So, for example, I'm just going to use FNB because I worked there years back. They have the global account. You can put that money in the global account. You don't need to put it back into rands, which means next year, if you need more than $1 million, I wish I can spend so much on holiday, but if you need more than $1 million on holiday, you can take the leftover from this year, 200,000 estimate, and $1 million, and then you can go on a long holiday. So those of you who are planning these long digital nomad trips, buy those dollars this year, because we can now subtly transfer to this year's, because remember, traveling allowances and SDA, single discretionary allowance, are calendar year allowances. We can move that to the next year. Then the big missing one is the one on loop structures. They have been promising us since March of 2021 that the Circular 1 of 2021, which was issued, I think, 6th of January 2021, dealing with loop structures will be changed. It has not been changed, but we see the change in policy. So one of the things that is extremely important on the loop structures to understand, when I sit in South Africa, I have an offshore trust, and that offshore trust invests back into South Africa. That's a loop. It was always totally legal. Then they lifted and said you can hold 40%. And then January 21, they said, provided you bring the cash into the country, it is okay, you can do it, you must put it on record. Then policy changed, and this is what they are applying at the moment. It must be fresh capital. You can't use round tripping, and you can't use this process to move your effective management or control of a South African company to a foreign shareholder. So, for example, if you worked abroad and it was foreign earned money, and you come back to South Africa and you have a foreign company, you can now buy into a South African company, no problem. The other important part on exchange control that has changed and, well, also not changed, is that we no longer have the tax immigration clearance, the TEC PIN letter. So sadly at the moment, and I say sadly because it causes problem at banking level, if you, in the old days, if we asked SARS for a tax clearance to go overseas and immigrate, we had to submit a list of assets, and they would issue a certificate and list what we called remaining assets, those shares in your South African company, because I wanted to have those shares stamped non-resident so the dividends can flow out. The manual by the Reserve Bank has not changed. SARS already in April, 24th of April 2023, removed the tax immigration clearance PIN, and they now only have an AIT. An AIT is only for capital transfers, because the Reserve Bank now says, very important, once you have the letter from SARS that you are non-resident, all your post-immigration income up to 10 million Rand can leave South Africa on a good standing. Now the banks are getting confused because they say, I want to know that that shares was listed on that application to SARS as a remaining asset. And we no longer on the RAV process, we're a bit technical, but the application we do, we have to list the remaining assets, but we do not have to provide a balance sheet at that date showing the assets. You only do it when you file your tax return for exit tax to pay your capital gains tax. So sadly, banks no longer have proof of what you listed to the reserve, up to the SARS, as an balance sheets or remaining assets. Because remember, the entire status of now being a resident for tax or non-resident is a process at SARS. That then you send to the Reserve Bank, and sadly, SARS are not sharing information. SARS are getting a lot of information, but SARS are not really sharing that information. So it's for you to upload it, but it's not a TCS PIN letter, so they don't have a code that they can check that if that is valid. So one of the things we hope SARS will soon do is change the immigration letter to a TCS PIN letter so that other people can externally check that. Remember, when you take money out of the country on an AIT, approval for international transfer, there's a reference number, the bank can look on that, and they don't see your profile. All they can see is that there is permission or there's a remaining balance of the 10 million that you can take out. And then the last one is, that's been for a while, but it was becoming much more easier to get more than 10 million rand out. You have to just justify it. SARS goes through a little bit of a deeper audit into your activities. And then once you've spent the first or transferred the first 10 million, the balance must be approved by the Reserve Bank. So there's a double process. So 10 million now per calendar year is a glass ceiling.
Fantastic. Thank you very much, Hugo. Then the other thing is there's always still this confusion and this thing, I think, around, tax immigration, financial immigration, those things. What is the distinction? And with all of these changes, I would assume that there's still and or there might not be. I don't know. Is there a distinction between the two? And if so, what is it?
So first of all, I'm one of those who say financial immigration really never existed. It was a brand name of someone. It was called formal immigration, and then someone branded it financial immigration. Old formal immigration was a process at the Reserve Bank, and then you had only one bank account, and it was a blocked account, and you could not access that directly. Now, since 2021, it's a process at SARS. It's merely called tax migration or ceasing of tax residency. There's no restriction on how many bank accounts you can have. You just have to have all that bank accounts and your then remaining assets classified as non-resident assets. But the Reserve Bank has a title for it. They call it immigrants assets, which means that you were born in South Africa. So although it's now marked non-resident, you can't just sell it and take the money out. You still have to do an AIT to get the money out. But if that shares, for example, the shares you're leaving in South Africa are now marked non-resident, the dividends can go out. Obviously, subject to a good standing. And secondly, there must be a reply on confirmation from the auditors that that company can afford to pay the dividends. Company law must be able to trade for the next 12 months and that the dividends tax was paid. So the process now to prove that you claim a lower dividends tax, remember 20 is the standard default. If you live in England, it's only 15%. Then they need a tax residency certificate. So that process is monitored by the Reserve Bank. All the taxman needs to tell you for post-immigration income is a TCS good standing. But if you want to take assets out after immigration, okay, and remember you've never given on that application, that motivation letter, you list your assets by name, but not by value. Then you have to go to SARS and say, there's my AIT application, and you have to indicate you're doing it as a non-resident, and they will then transfer it. And then be warned, if you have failed to notify your bank that you are tax non-resident, you now present them with a letter from SARS saying an AIT PIN non-resident. Then the bank now first have to go through a process to convert your profile to non-resident. And now people get very annoyed because you know what banks do? AI and risk management account is FICA blocked because they know the address in South Africa is incorrect. And secondly, they do not have your CRS, Common Reporting Standard updates. So if there's one thing I can tell people, what's the big difference is that in the old days, it was Reserve Bank, and then all banks knew you left South Africa. Now it's SARS, you do it at SARS, and then you, the taxpayer or your accountant, needs to go to all the financial institutions, the fund managers, the unit trust managers, and the banks to classify you as a non-resident immigrant account. which means there's still exchange control applicable to you, but it's just easier. There's a distinction between capital and income.
It is definitely not getting easier. Although it feels to me like, as if, I mean, that's the intention probably to make those things easier, but it feels it does get more complicated, and there's also more work being shoved on.
Can I underline that for you? And that's so critical. It's very important that you notice that, because people come to me and say, but exchange control has been lifted. It has been relaxed. It's not lifted. It is still there. But we must forget, at the same time, SARS has become more aggressive. And secondly, we are grey listed. So now what happens is that the process is more paper driven. The paper chase to become a non-resident is much bigger than on the old exchange control formal immigration. But the difference now is, once I've done it with SARS, I can come back at any time and I can stay back out as long as I want to. At the Reserve Bank level, the old one, you had to undertake 5 years not coming back. And if you came back, there were some penalties and recourse from the Reserve Bank. The taxman says, no, it's an annual process. You don't have to apply every year. But if you're going to the UAE, where I am, and your work permit is only 2 years, you can be tax non-resident for 2 years. That 2 years, because in Dubai, they normally work on calendar years, that could be 3 tax years that you're non-resident, but it's fine. You can go back, you can go out. We saw in COVID time, people left countries like England, and that lockdown, you couldn't go back. They became tax residents again. After 2021, they then went back to England or US. Australia was, I think, the longest lockdown. Then they could go back to Australia. Then they re-tax immigrated. So now you can do it in multiple times in your life. So that is a very, very important thing, is that the Reserve Bank was very restrictive, blocked account. You couldn't access your money. Now, as a tax immigrant, you can open a new account at any time in South Africa. And our banking system is so modern. My business partner, Matthijs, opens bank accounts remotely for any South African sitting anywhere in the world.
Yeah. That's quite interesting, right? So there's a lot more flexibility. So I have to ask this question. So how does the ordinary residence test and the physical presence test and those things, how do they now play into all of this? Are they still relevant? When are they used?
Very good. Now, remember the old formal immigration days, you had to make a promise of 5 years. There was no intention. You never showed or never undertook to never come back. On the SARS process, that declaration you sign has 3 options. You can either be tax non-resident on the physical absence test, which is 330 days. I'll come back to that one now. Very few people can do that. The second one is you tax non-resident in terms of the treaty. That is someone that's, for example, in the UAE. You know you're going to come back because UAE does not give indefinite leave to remain. UAE, they maximum give you a 10-year golden visa, but they don't give you a passport. Absolutely not. So you are treaty non-resident. It means if you come back to South Africa, or the treaty changes, or the tiebreaker rule changes, then you can no longer be resident and you're back in South Africa tax resident-wise. And then the third one is when you tax immigrate and you say, I am no longer ordinarily resident. So that's a lifestyle test in the first instance. Secondly, you must have the ability not to come back. You must then have, if you, for example, stay in the UAE, then you must have a UK passport or US passport to show that after I lose my job in the UAE, I need not come back to South Africa. I can go to another country. And then you must also have the intention not to come back. And that's, again, links a little bit with lifestyle. So I recently had a case where someone has been 3 times now declined at SARS level. And SARS's answer was clearly, you are contributing 350,000 Rand a year to a South African retirement annuity. South Africa. You are planning and funding retirement in South Africa. So your lifestyle and your financial footprint is not aligned with what you are telling us as taxmen. Just quite interesting, why the difference between treaty and ordinarily? If you're treaty non-resident in the UAE, you pay worldwide estate duty. There's no treaty with the UAE on estate duty. In fact, there's only effectively UK and US treaties on death tax. The rest, we pay death duties, even if you die in the UAE. If you're ordinarily no longer resident, then you only pay South African estate duty on the assets physically, the situs assets in South Africa. So that's the difference. If I can quickly go back to the 330 days, most people come to me and say, I've been out 11 months or 12 months. I never touched South African soil. I'm now tax non-resident. Unfortunately, that test is only applicable. It's only applicable to people who became tax resident on the 5-year rule and remained tax resident on the 5-year rule. Because in that 330 rule, it starts off right at the beginning. For any person who in any relevant tax year was never ordinarily resident, then it's the 5-year rule. So if you have been ordinarily resident, like most born South Africans, you cannot use the 330 day. If you were born here and you were about 6 years old when your parents left, then you're probably not ordinarily resident because you have a South African ID, you were born here, but your ordinarily residence is in a different country. And that's one of the things where we see on the Reserve Bank, and I think one of those circulars that are missing when we now read at the moment, which we hope will be finalized on the 21st of May in the then announcements. We are now able to take money out for people that were children when their parents financially immigrated. Because remember, when you were 6 years old and your parents financially immigrated or formally immigrated, your name was on the application, but on the tax clearance certificate, there was never a reference to you because you didn't have a tax number. So that person can be ordinarily non-resident. And if they came to South Africa for a short period and went out 330 days, they can probably use it. But on average, a born South African who spent most of his life in South Africa should forget the 330 days. Go for the tax treaty and go for the ordinarily no longer residence. I suggest to my clients, first get the treaty one, and then we can later beef it up to no longer ordinarily resident. Because we have situations where people going to the UK, they do not have indefinite leave to remain for 5 years. They have the intention not to come back, but not the ability. So let's just do that tax treaty one, because the UK deems you tax resident in one tax year, not 5 like South Africa. Therefore, you're non-resident, and then when you have your indefinite leave to remain, there's no additional exit tax. Then we place on record, I have no intention to come back, and you remove the estate duty problem.
Fantastic. Well, not fantastic about the whole setup. That sounds like very complicated to me in the sense of there's so many moving parts and so many things, and it is literally done on a case-by-case basis. So there's no general rule to say, I mean, anything could apply to any person. Of all of the things that we've spoken about so far is the sense I'm getting that, you know, it is a case-by-case basis, and you've got to understand what happens when you pull this string, what's happening there. You know, so it is quite an interesting arena to play in, I think, and that's why we got to ask these questions about clients. You know, we often hear that they're moving overseas and they're doing this and that, and then I don't know how much, because often, I don't know, today still, if I remember back when we spoke 2019, 2020, etc., that a lot of the times people thought about tax stuff after they went to work overseas, for example, or those things. Is that still the case, or are they at least now a little bit more proactive and say, oh, well, before I leave, I need to maybe just figure out how these things work? Or is that still what?
You know me, I'm not a fearmongerer, and I'm not someone who likes this profound statements. But the one that I must tell you, what is causing a lot of inquiries is in budget 1 and budget 2, it stated that they now intend to tax foreign pensions. At the moment, as the law stands, if you earned your salary outside South Africa, you contributed to that pension fund whilst abroad, the English one. When you come back to South Africa, that pension fund at the moment is tax-free in South Africa. Plus, the UK doesn't tax you because you're not there anymore. And the minister has now said he's not given us draft bills, tax bills. He's just said now, in principle, he wants to tax that because the tax treaty allows us to do that. Now, suddenly, people are waking up to the fact that if they made it clear to SARS that they are tax non-resident, when they come back, their pension in a foreign country is actually tax-free. So it is suddenly quite a topic at the moment to legally, and you can legally, backdate your assets. Secondly, the other one that we are seeing is specifically our UK taxpayers. They are suddenly coming back to South Africa for a very, very interesting reason. in the old days when people were elderly British, South Africans in Britain, but they haven't been there 20 years, they didn't pay estate duty on their assets outside South Africa, unless they outside the UK, unless they were there 15 to 20 years. So it took a very long time before they paid estate duty that side, and they were out of South African estate duty because they were no longer ordinarily resident. Now suddenly, the UK says if you're a normal resident, like a South African, and remember they become resident after 193 days in one tax year, they are now subject to worldwide death duty or AHT. So now suddenly people that are living there for 12, 13 years have a British passport, or is it I'm not domiciled because I was not born in the UK, so I'm not going to pay UK death duties, and South Africa is not going to tax me on my assets outside the UK. So these assets were paying tax in the UK, but the assets were lying in Isle of Man, Channel Islands, America, wherever, countries where there were no big estate duty charges or citus tax. Now suddenly they have to pay that tax if they die in the UK. And the UK has now said, if you come back to South Africa or you leave the UK and you are no longer resident in the UK for 10 years out of 20 years, you're outside of the AHT or inheritance tax. Okay, so interesting. You can now come back to South Africa as an older person. Because you do not have at the moment a South African passport, you still have a non-citizen's ID. You can argue with the Reserve Bank and SARS that I am coming back temporarily because I'm just leaving the UK because of their tax system. I'm coming back to South Africa, but I don't know where to. I'm a Soweto. So where to now? I'm planning Thailand or I'm planning Portugal or whatever. So now South Africa can't tax you on worldwide assets on death because you're not ordinarily resident. Because remember, if you were not ordinarily resident when you came back to South Africa, you can use the 5 years before you become tax resident. The UK again, the minute you've left, you fill in the form and you tell them, I've left. There's no exit tax in the UK. So suddenly, where people were not coming back to South Africa, they are coming back to South Africa for various reasons. We obviously see the economy in the UK is not that good. But we all see in the newspapers about 40 people leaving the country as so-called refugees, and we all get excited and we forget. The reality is South Africa remains an interesting and popular destination. That is why Home Affairs has introduced a digital nomad visa. In Cape Town at the moment, the majority of my clients are not ordinarily resident. They are in South Africa on a digital nomad for 3 years, so they will not become tax residents. They are paying tax on the money they earn in South Africa, but they are enjoying the life in Cape Town, despite the fact that our rents are so high, despite the fact that we have all the traffic problems in Cape Town, despite the weather in Cape Town. But you told me today the weather is not that bad. So secret season in winter is very attractive for nomads. But the point I want to make is that every case is different, and we are not just seeing a lot of people fleeing. We are helping as many people to either come back or to come and stay temporarily.
Fantastic. Thanks, Hugo. Then, let's just maybe briefly, just briefly talk about this digital nomad visa. I mean, it's only like 5 years late, it feels. Everybody else was doing these things when COVID happened already and said, oh, come and work here and, do this and do that. And then, okay, now we also got on board. But what can you tell us about this? Just maybe briefly, just so that people know exactly. I know you've already mentioned a couple of things, but I think, if you think about, let's just say there's an influx of people into South Africa that wants to come and work here in Cape Town, enjoy everything that we're enjoying, then, can we handle those things? Because, yes. Do they need to report things, et cetera, et cetera? So maybe just a brief overview.
Yep. So recently we saw that Home Affairs and SARS now have a very close relationship. And the interesting reason is two things. A digital nomad who asks for a visa more than 3 months must have a tax number before he gets the visa. How clever of SARS, okay? Secondly, we all have e-gates. So that was one of the shocks of my life in Johannesburg when I left Johannesburg 2 days ago flying to Abu Dhabi. No e-gates. I have had no entry-exit stamp in my passport using Cape Town Emirates Airlines for about 2-3 years, because in the UAE, I scan my passport, look into the camera, I don't have to even give my ID or anything, and I walk through. And I could have left, and I've been leaving Cape Town for now over 2 years on e-gate. So Home Affairs and SARS are working. Very clever two departments. And we have seen the upgrade in Home Affairs. So the new minister, the GNU minister, has now introduced in October last year the formal rules. And very interesting, if you come in and you are on a more than 3 months visa, there you can get 3 to 36 months. Then you need a tax number before you start, and you pay the tax. You can have a non-resident bank account, so exchange control, you're non-resident. We call you foreign national with consent to bank. Now suddenly you have a bank account, you can go and rent a property in South Africa. You are spending money in South Africa. And it feels to us, Francois, that the majority of them in Cape Town, I must tell you, I find a huge percentage, funny enough, going to Johannesburg, because from there they can travel this time of the year specifically into game reserves, people who want to be more adventurous. In Cape Town, we are seeing an extreme concentration of digital nomads in little towns like Hopefield. Why? Hopefield, the entire town has Wi-Fi. So why would they not go to Hopefield? Cost us less. It's very close to the West Coast. Nice traveling. I was recently in Hermanus. I lived there before. Rent has always been extremely expensive, but cheap in winter. This year, there's nothing available. People on Facebook groups are asking, help me to get accommodation. When I started asking, they said the number of digital nomads in Hermanus is just unbelievable. And I said, but the weather, it's winter. Why would they go there? The whales, adventure. So it's quite interesting. Digital nomads are not always destined for big cities. As long as they have Wi-Fi, they have the permit, and they pay the tax, they're in South Africa, and they're enjoying the entire country. So I'm sure there's people who travel more than I do in South Africa. Probably tell me there's digital nomads in Kuruman for all we know.
Yeah, I'm sure. They might be asking the question, how did I land up here? But who knows, maybe, or Henneman in the Free State. Okay, so fantastic. Well, at least now there are options and to obviously get people to come and visit our country. But then also, there's also been a big, I always want to say, a trend when it comes to residency by investment, and often, I don't know, like it's positioned as there's all these amazing tax benefits to do that. Is that really why people are making use of this?
Sadly, they are still doing it, and they're being misled because they hear the tax rate in Portugal is 10%. Okay, it's good. You can get the tax rate in 10%, but you must pay first the exit tax to get out of South Africa. And that 10% is only on income not taxed in another country, okay? So, for example, if you are tax resident in South Africa and you go to Portugal and you do not become a full tax resident on that side, then you are paying 10% on what you're earning there. But in South Africa, you're resident, the first 1.25 million is tax-free, but everything above that, you're going to top up. You only have a 10% credit. Therefore, you're going to top up and you're still going to pay. So if it is a country where you can leave from South Africa and have a treaty exit, do it. But countries like Panama and countries like Thailand is extremely difficult to get out of the South African system. Thailand, we have a treaty, but Panama, we don't have. But what's the problem in Thailand? In Thailand, South Africans or non-residents cannot buy land. You can buy what they call a condominium, so a sectional title, but anything that is linked to land, you cannot buy. And the rent there is becoming more and more expensive. And those investor visas, which they told everybody, if you're a rich person or retiree, you can go in there. Yeah, it's fine. But you're earning very little there. They have remittance tax. So if you want to keep the lifestyle you had in South Africa, you must probably send 3 million rand a year across to Thailand. Suddenly that is taxed at 25, 26%. Okay, it's lower than 45. But tax-free investor visas is not always what it used to be. Furthermore, Spain, very popular, has this lower tax rate for the first 3 or 4 years, where the first, I think, 600,000 euros, it's a lot of money, I wish I could earn that, is at a lower tax rate. But the minute your employer is linked to what they call blacklisted countries, then you cannot get that exemption. And one of the problems we have is not a South African, it's a Namibian. Namibia does not have worldwide basis of taxation, but they have not signed up to CRS. So his bank account, his money is flowing from Namibia to Spain, and Spain has now said, sorry, no tax exemption, because Namibia is a non-cooperative CRS country, which means it has signed it or busy signing, but never implemented. So yes, those things are still popular. It is still a plan B, but the tax saving that side has a flip side. It's only true if you can get out of the tax in South Africa.
Interesting. Then, Hugo, I've got two quick questions. The one is, let me just finish this, and then there's one of the questions in the comments that I want to ask you. But as financial advisors, financial planners, I mean, you get to work with many of us. And are there any particular things you see that we either get wrong or miss when working with clients who's becoming expat, or they're leaving or coming back, or any of those?
Can we have another year? Can we another year's presentation every Friday? The biggest one. I beg you guys, if the guy has an offshore trust, do not use a South African 5-year product. Okay, it is a loop. You are creating a loop. We are using foreign funds with a foreign entity investing into South Africa, okay? Because that fund is paying tax in South Africa. So even if that fund is sitting in Guernsey or Channel Islands, you know which products they are, okay? They on their offshore platform, but they are paying tax in South Africa. They are a taxpayer in South Africa. So by definition of the Reserve Bank, currently, they are a loop. We hope they're going to change that. Secondly, if my client is living in the UAE where there's no personal tax, why do you put him in a 5-year product that pays 30% tax on income and 12%? If I find you, I'm going to report you. You need to know the tax law. Do not invest a tax non-resident in a South African product, paying tax, selling to him that after 5 years, it's tax-free. It is not tax-free. The second one is, when people are coming back to South Africa, that's the time that you move them from an international fund not paying South African tax, and you put them into a South African fund, and then you go to the Guernseys and Jerseys and those type of funds, because you are entitled to keep that money there. Please do not make your returning expats invest into a retirement annuity or pension fund in South Africa. I know there was a recent ruling by SARS that a lot of these 40EEE funds are no longer pension funds. They are deemed to be trusts. That is no reason to bring the money back. Then put it into a product that is in a different country. And you know what is so nice about that product? I'm not a financial advisor, so I'm giving you the tax and estate planning benefits I see. You can nominate who is the beneficiary, so you don't need probate, you don't need a second will. Secondly, the Reserve Bank now, since Circular 6 of 2024, says you can leave that asset. A South African with a foreign asset can bequeath an asset that's abroad to my children living in South Africa, and they don't need to bring it back. So yes, those products have a place, but the day that I come back to South Africa. And please don't put that product in a trust, because now Section 7C, that one on interest-free loans to the trust, okay? If you have not paid tax in terms of Section 31, the international equivalent, then 7C applies. So now you have a product, tax-free, in a trust offshore. There's a loan account from the South African to that trust. You are not paying tax in terms of Section 31 because there's no tax saving. Beautiful argument. Sometimes I don't believe it's the right argument, but that's fine. So SARS went and said, we're not going to fight you about this, whether Section 31 applies. We are now changing, as of this year, if you did not pay tax in terms of Section 31, you are now going to pay donations tax in South Africa on that loan account just because that taxpayer came back. So for a returning expat, having a naked investment, 5-year plan, those endowments or sinking funds, please have it abroad, but in own name. Secondly, the other important part, please go and look at these non-domestic policies. they remain outside South African exchange control. They remain outside South African estate duty, provided the money does not come back to South Africa, it's paid to a foreign bank account. So if your client has estate duty exposure, because remember, that 5-year product is estate dutiable because he came back to South Africa. Add, if they're young enough and affordable, a non-domestic policy. Or, and that's my big plea, if you have young children or youngsters going out, which you can identify in future is going to be a high net worth individual, coming back to South Africa, start that non-domestic policy now. It's affordable. Maybe your commission is not as high as on the South African products, but think about that guy's future. When he comes back, he has a foreign currency, hard currency policy, which his children can keep abroad. Secondly, as the estate duty stands at the moment, it is not an estate dutiable asset. And thirdly, it is not under control of the executor, no fees, and that money is immediately available. So yeah, I'm not very favorable with my colleagues in the financial advisor industry. I'm tax driven, so please, my disclaimer, I'm not FPI registered. I'm not a financial planner. I give a tax opinion.
Yeah, no, and I think it's important to know all these things, because there's often we do things, coming from the intent is good and sort of based on what we know, but there's always something that we don't know what we don't know. So I think it's important for us to hear these things. And then just one practical quick question, if you can just give a brief answer there, Hugo. So practically, how do I know the person I'm working with is resident or non-resident for tax? What is the right place to confirm that today? Because some people might have left before, some people might have left after the changes and all of that. How do I know when I get specifically a new client whom I don't know, how do I know that they are resident or not resident? What's the best way to know?
You cannot check with SARS, unfortunately, but they can provide you that tax letter that says you are deemed to be non-resident from an effective date. Okay. There's no ways to see if that letter is still valid, because it says if you come back within 21 days, you have to notify them. So all you do is get that letter, okay, and you can't check that validity on e-file, and then you ask them, give me a TCS good standing, provided they have a tax number. But remember, for most of my clients who has no remaining assets in South Africa, I then deregister them from tax. It's an additional process. I deregister them because when their parents die, if I have that letter and they're inactive on the SARS system, I can take 10 million from the executor's account without an AIT approval abroad.
Thank you very much. Hugo, your time has flown. So we are at the end. Thank you very much for everything that you've shared. Thanks for everybody's questions. Hugo, I know the comments doesn't always immediately come up when the recording is available, but if you want to come back, I think by tomorrow, usually then the chat is there. If you do want to answer some of those, maybe I'll see. Maybe we can copy some of these also and send it to you. I don't know how I'll get it to everybody, but it would be maybe good if somebody could answer those.
I've been following them, and I just want to say to Kobus Klein, he's obviously listening, heard me gossiping about him. Thank you, Kobus, for the comments. And then just one on Neil Phillips says, any comments on the dollar-denominated life cover available by certain product providers in South Africa? That's perfect. If it's on their foreign platform and you pay for it in dollars and it pays to a non-resident bank account or a foreign bank account. So if your beneficiary is your 18-year-old child, go and open a bank account, give him joint signatory, or make it a joint bank account so that when you die, that account has continue, it doesn't close, and it can pay to his foreign bank account. So those non-domestic policies, please use the South African product providers. I'm just against the products that are paying tax in South Africa for non-residents.
Awesome. Righty. So on that, Hugo, thank you very much. Thank you for all the insights, for everything that you share. You're always open to share. If anybody wants to get hold of Hugo, LinkedIn, right? You don't even have to ask, where can I find Hugo? Go to LinkedIn. I promise you'll find him there, and Hugo is very responsive. There's also the websites and everything, but I believe we did put all the links down below in the description. And Hugo, on that note, thank you very much. Good luck with your next stint there over in the UAE. Have a good time, and we'll see you somewhere when you're back.
Thank you. And in closing, Francois, congratulations what you've done. When you mentioned 2019, it's 6 years, and you've just PROpulsion, and you have just grown and to become a big player in the market. And what you've done for me and my practice, thank you so much.
Big pleasure. Thanks, Hugo. All right. I can just say thank you. It's a pleasure. All right. So that's it for another episode. And we are excited. And now I can't remember who my guest is next week. Let me double check quickly. Let me just see. It is possibly here in my notes. I got so enthralled. No, it's not. So give me 1 second. I'll tell you exactly who next week's guest is. And our guest next week is none other than Rudolf Geldenhuys. So Rudolf will be our guest next week. He's the current Financial Planning Institute's Financial Planner of the Year for 2025, I believe. And so going to talk to him. I mean, you've seen Rudolf here on the show and the segment that he hosts, but we're going to get into it a lot deeper about a couple of things next week. So looking forward to having Rudolf on the show. So on that note, thank you very much for joining us. If you watch the recording, thank you very much. Please remember to subscribe and like the video and share it with others. But go have a fantastic weekend. Stay safe, be blessed and prosper, and stay curious and continue to raise the bar. Bye-bye.
Thanks for joining us on Propulsion. If you found value in today's episode, then there's plenty more where this came from. You can find all our previous episodes right here on the podcast, as well as on our YouTube channel. And talking about the YouTube channel, we go live every single Friday at 8 a.m. until 9 a.m. and we host many different guests, and we also talk about very interesting topics. And on the live show, there's also some incredible segments hosted by some of the most well-known and influential financial planning professionals. So you are most welcome to join us every single Friday. Put it in your diary and we will see you there. And on that note, also please do check out propulsion.co.za/community for all of the goodness and learn more about how you can become part of our amazing community and how that would benefit you, your business and your career. So on that note, stay curious and keep raising the bar.